Imagine a business structure where every dollar of profit you earn is taxed just once, directly to you, avoiding that dreaded double taxation.
Right.
Sounds like a dream, doesn't it? A real unlock for your financial future. Well, for countless entrepreneurs and savvy business owners, that dream isn't just wishful thinking. It's a very real and powerful reality.
It really is.
Today, we're taking a deep dive into the often misunderstood but incredibly impactful world of partnerships. We're not just going to tell you what they are.
No.
We're going to expose how a deep understanding of their tax intricacies, particularly the nuances of Subchapter K rules, can empower you to keep significantly more of what you earn. This isn't just about ticking boxes for compliance. It's about strategic optimization. It's about unlocking true tax efficiency.
Exactly. We're going to systematically unpack the advanced tax topics of partnerships. We'll guide you through their very formation, how income and expenses flow through, how distributions are treated, and even how potential losses can be fully utilized. Our mission today is, really, to transform dense tax code into clear, actionable insights.
Actionable, that's key.
Right. Helping you grasp the critical nuances that can make a real difference in your financial planning and, well, most importantly, your bottom line.
You've provided us with some incredibly valuable sources, and our goal today is to extract the most important nuggets of knowledge. The true strategic plays, really. The things that will help you optimize your partnership's tax position. So let's roll up our sleeves and get started on this deep dive. Let's kick things off with the absolute cornerstone of partnership taxation. This concept of flow-through entities. We hear this term all the time.
We do.
But what does it truly mean for you, the business owner, and why is it such a profound tax advantage? How does it put more money back in your pocket?
Well, what's truly fascinating and really powerful here is that a partnership acts like a transparent pane of glass for tax purposes.
Okay, transparent.
Yeah. Unlike a C corporation, right, which is treated as a separate taxable entity, their income gets taxed at the corporate level.
Right.
And then again, when distributed to shareholders, that's that dreaded double taxation we mentioned.
Nobody wants that.
Exactly. But a partnership's income is taxed only once. It flows through directly to the partners.
So the partnership itself doesn't pay the tax.
Correct. The partnership itself doesn't pay income tax. Instead, each partner reports their share of the income, deductions, credits, losses, all on their individual tax returns.
Oh, okay.
This single layer of taxation is a monumental draw for businesses, especially, smaller and mid-sized ones, seeking maximum tax efficiency.
Makes sense.
And this applies broadly to general partnerships, limited partnerships, even LLCs that elect to be treated as partnerships for tax purposes.
Right, the check-the-box selection.
Exactly.
Yeah.
It's fundamentally about avoiding that second bite at the apple, making sure more of your hard-earned profits remain precisely where they belong with you.
That transparency is clearly a huge benefit. Now let's talk about actually getting this partnership off the ground.
Sure.
Many listeners might assume, maybe logically, that bringing property, land, equipment, even just cash into a new business would trigger some kind of tax event immediately. Is that generally the case with partnerships, or is there a special rule here?
That's a great question, and it really speaks to one of the most beneficial aspects of partnership formation. Generally, no.
No.
There's a powerful non-recognition rule at play here. When you contribute property, an asset with an existing value and basis in exchange for a partnership interest, you typically do not recognize any gain or loss at that moment.
So no immediate tax bill just for starting up?
Right. You're not hit with an immediate tax bill just for forming or joining the partnership with assets. Think of it like a tax-deferred rollover.
Okay.
You're simply changing the legal form of ownership, not necessarily triggering a taxable disposition right then. This deferral of gain recognition is an incredibly powerful tool for structuring business contributions.
I can see that.
It allows entrepreneurs to pool resources, get a business off the ground, without facing an immediate, potentially burdensome tax liability.
So let's make that really concrete. If a taxpayer contributes land they've held for years, maybe it has an adjusted basis of $30,000, but its current fair market value, the FMV, is $50,000.
Okay.
They're not recognizing that $20,000 gain right away, correct? They don't owe tax on that appreciation just yet.
Precisely. The sources are very clear. No gain is recognized at the moment of contribution. That $20,000 built-in gain is deferred.
Deferred.
Yeah, like hitting the pause button on the tax clock for that gain. This deferral allows for, a seamless integration of assets into the partnership without an immediate tax burden.
which must be a powerful incentive.
Oh, absolutely. Particularly for businesses transferring appreciated assets. You get to defer that tax liability until a later date, typically when the asset is eventually sold by the partnership, or maybe when you dispose of your partnership interest. This foresight in the tax code truly makes it much easier to merge or start businesses without that upfront tax event.
Now, here's where it gets really interesting, I think, especially for someone contributing their expertise, their knowledge, rather than just cash or property.
Ah, the service partner scenario.
Exactly. Not all partnership interests are created equal, are they? We need to distinguish between a capital interest and a profits interest because the tax implications are, well, dramatically different.
This distinction raises a crucial question for anyone planning to join a partnership using their skills.
Right.
What's the tax difference if you're bringing your expertise or services instead of, say, cash or a building?
Right.
A capital interest essentially gives you a right to share in the partnership's existing net assets if the business were to liquidate today.
Okay, so like a piece of the current value.
Exactly. Think of it as owning a piece of the partnership's current tangible value. It's cash, it's equipment, it's real estate right now. A profits interest, on the other hand, is fundamentally different. It's solely a right to share in future profits or losses.
Future profits, not current assets.
Correct. It's about your slice of the business's ongoing earnings and growth potential with no claim on the current underlying assets.
Yeah.
And this distinction is absolutely crucial for tax purposes because, as we'll see, one generally triggers immediate taxation, while the other offers a significant tax deferral.
So let's say I'm an expert in my field, and I'm being brought into a partnership purely for my services, and I'm granted a profits interest. Am I taxed immediately on that future income potential? Because that could be a huge barrier for talented individuals.
No. And this is a truly significant advantage, particularly for service-based partnerships and attracting key talent.
Okay.
The sources clearly state that when a partner receives a profits interest solely in exchange for services provided, they generally do not recognize any compensation as ordinary income at that time.
Why not?
Because a profits interest represents uncertain future profits. Its liquidation value is often considered zero when received. There's no immediately measurable current value to tax.
I see. It's speculative.
Pretty much.
Yeah.
It's a powerful incentive built into the tax code to encourage individuals to contribute their valuable skills and expertise without facing an upfront tax burden on what is essentially a future uncertain income stream. It makes your offer to a key hire far more attractive, doesn't it?
It definitely does. So to put that into an example, if a taxpayer gets, say, a 20% profits interest for services, and the partnership's current assets have a basis of $20,000 but a liquidation value of $80,000.
Okay.
Do they recognize income right when they receive that 20% profits interest?
The solution is clear. The taxpayer will not recognize income at the time the profits interest is exchanged for services, even though the partnership itself might have a significant current liquidation value, $80,000 in this case.
Right.
Your share of future profits as a profits interest holder isn't immediately valued or taxed.
Okay.
This means you can get your foot in the door without an immediate tax liability on the value of that future income stream, a massive deferral benefit.
And a key reason why profits interests are so appealing for service partners.
Exactly. Or those being brought in for their intellectual capital.
But what if, instead of a profits interest, it's a capital interest I receive from my services? Does that change the tax picture immediately? Is that where the tax bill comes in?
Absolutely. It's a completely different story, and this is a critical planning point. If you provide services in exchange for a capital interest, the fair market liquidation value of that capital interest is included in your taxable ordinary income immediately.
Okay, so it is taxable right away.
Yes. This is essentially seen by the IRS as compensation for your services, immediately taxable at its fair market value at the time you receive it.
And the logic there is?
The rationale is that a capital interest has a present determinable value. If the partnership were to liquidate today, you'd actually receive a share of its current assets.
Makes sense. It's not just future potential.
Right. And the partnership, in turn, can either deduct or capitalize this amount, depending on the nature of the services, allocating that deduction among the pre-existing partners. So careful planning around the type of interest you're receiving is paramount.
Paramount to managing your immediate tax burden.
Absolutely.
So back to that example. Taxpayer receives a 20% capital interest for services. Partnership assets have a liquidation value of $80,000. How much income do they recognize right then?
They will recognize ordinary income of $16,000.
$16,000. Okay, 20% of the $80,000 liquidation value.
Precisely. This example highlights that critical planning point. Understanding the type of interest you're receiving is paramount to managing your immediate tax burden.
Huge difference. $16,000 in income versus zero.
Exactly. While a profits interest offers that valuable income deferral, a capital interest creates an immediate taxable event. For a new partner, this difference can mean a substantial, maybe unexpected tax bill versus no immediate tax liability. It makes the distinction incredibly important for, financial foresight and negotiation.
We've talked about the general rule of non-recognition for contributions, but are there any other scenarios where contributing property could still trigger a gain? Are there traps we need to watch out for?
Yes, there's a specific and often overlooked exception involving liabilities. And it's a nuanced but incredibly important one to understand.
Liabilities. Okay.
This is where a seemingly simple contribution can inadvertently trigger an immediate tax liability. If you contribute property that's already subject to a non-recourse secured debt, meaning the debt is tied to the property, not your personal assets,
Right.
and the portion of those liabilities assumed by the other partners exceeds your adjusted basis in the contributed property.
Ah, okay. Not the total liability, but the part shifted to others.
Exactly. If that shifted amount exceeds your basis, that excess is treated as taxable boot to you, and that boot will result in a recognized gain right at the time of contribution.
So you get cash out, effectively.
Sort of. It's treated as if you receive cash to the extent the liability relief exceeds your basis. It's a very specific but important nuance to watch out for, as it can inadvertently trigger an immediate tax liability, even in an otherwise non-recognition event.
Now let's tackle basis. It's a term that comes up constantly in tax discussions, and it's truly the backbone of partnership taxation. Specifically, we're focusing on the outside basis,
Right.
which is your personal basis in your partnership interest. Why is this concept so crucial, and what exactly goes into calculating it?
Your outside basis is, well, it's truly your lifeline for tax purposes. Think of it like your personal financial foundation within the partnership.
Your stake.
Your stake, exactly. It's incredibly crucial because it dictates how much income you could defer, how much loss you can actually deduct, and ultimately your gain or loss when you eventually sell your interest.
Okay.
And what's truly unique and a significant advantage in partnerships compared to, say, S corporations, is that your share of partnership liabilities increases your basis.
Ah, that's interesting. Debt increases basis.
Yes. This allows partners to deduct losses and receive distributions that might otherwise be limited if debt wasn't included. It provides significant flexibility and powerful tax benefits.
So it's fundamental to leveraging the structure.
Absolutely. It's fundamental to leveraging the partnership structure for maximum financial advantage. Without accurately tracking it, you're essentially, flying blind on critical tax decisions.
So if I'm a new partner, how do I go about calculating that initial outside basis? What are the building blocks?
It starts quite simply with your cash contribution plus the adjusted basis of any property you contribute.
Okay, cash plus property basis.
Right. And if you received a capital interest for services, the fair market value of those services is also included, as if you contributed cash.
Got it.
Then you subtract any liabilities on contributed property that are effectively assumed by the other partners. This is crucial.
Right, the part you're relieved of.
Exactly. You're only reducing your basis by the amount of debt that leaves your personal responsibility and is shifted to the group. And finally, and this is that unique partnership advantage we just mentioned, you add your share of the partnership's liabilities, whether they are recourse or non-recourse debts.
Okay, so it's a formula.
Right. If we put it into a concise formula, it looks like this. Cash contributed plus property contributed, adjusted basis, plus services contributed, FMV, only if it's a capital interest, liabilities on contributed property assumed by other partners, plus your share of partnership liabilities, your initial outside basis.
That makes sense.
This dynamic calculation is the key to understanding your true economic stake and, more importantly, your immediate and future tax implications.
This inclusion of debt in basis seems like a really powerful aspect for tax planning.
It is.
How the partnership's debt is allocated to you directly impacts your basis, and obviously depends on the type of debt and your role in the partnership, right?
Right.
General versus limited partner.
Precisely. This is a critical area where understanding debt structure can significantly impact a partner's ability to take losses and optimize their tax position. Let's break down the types.
Okay.
First, recourse debts. These are debts for which one or more partners have personal liability.
Meaning the lender can come after their personal stuff.
Exactly. If the partnership can't pay, the lender can pursue the personally liable partner's individual assets. A general partner, for instance, is inherently personally liable for all partnership debts, unless agreed otherwise.
What about limited partners or LLC members?
Generally, they are not personally liable unless they personally guarantee the debt.
Ah.
Because of this personal exposure, recourse debts are only allocated to those partners with personal liability.
So if you're a general partner or guaranteed the debt, your basis goes up.
Right. By that amount, allowing for greater loss deductibility and more flexibility with distributions.
And the second type?
Non-recourse debts. These are typically secured by specific partnership property. The creditor can only go after the secured property if the partnership defaults, not the personal assets of the partners.
Okay, so less personal risk.
Right. And because they are not the personal responsibility of any single partner, non-recourse debts are allocated to all partners or LLC members based on their profit-sharing ratio.
All partners, even limited partners.
Yes. This is a significant distinction because it allows partners without personal liability, like limited partners or LLC members, to still increase their basis through their share of this shared non-recourse debt.
Which could be a key advantage, maybe in real estate deals.
Exactly. For real estate or other capital-intensive partnerships, this can be crucial.
Let's make this really concrete with an example. Take A-B partnership, two equal partners. A is a general partner, B is a limited partner. They take out a $100,000 loan.
Okay.
If it's a recourse loan, how does that impact their individual basis calculations?
Okay. If that $100,000 loan is recourse debt, the entire $100,000 is allocated solely to partner A.
All to A. Why?
Because partner A, as the general partner, has personal liability for that debt. Her basis will increase by the full $100,000.
Giving her more room for deductions or distributions.
Exactly, significantly enhancing her ability. Partner B, as a limited partner, gets none of that recourse debt allocated to her basis unless, again, she had personally guaranteed it.
Wow, stark difference.
It really highlights how the type of debt directly shapes a partner's ability to absorb losses.
And what if that same $100,000 loan was a non-recourse loan instead?
Different story. If it's a non-recourse loan, both A and B, as equal partners, would each increase their basis by $50,000.
Based on their 50% profit-sharing ratio.
Correct.
And what if this was an LLC with two equal members? How would that loan allocation differ for recourse versus non-recourse?
Good question. For an LLC with two equal members, a recourse loan generally doesn't increase either member's basis.
Unless
One or both of them personally guarantee it. LLC members generally have limited liability, similar to limited partners. So the recourse debt doesn't automatically flow through unless they actively take on that personal risk.
But non-recourse does.
Yes. A non-recourse loan for an LLC is allocated equally, just like in the partnership example, increasing both members' basis by $50,000 each in this case.
So for an LLC, non-recourse debt is often the main driver of basis increases from liabilities.
Often, yes, providing crucial capacity for loss deductions. And there's also an important pass key here, something to really remember.
Okay.
A loan from a partner to the partnership is always treated as recourse debt.
A loan from a partner?
Yes. And because the lending partner effectively bears the economic risk of that debt, it is allocated entirely to the partner making the loan, increasing their basis.
So the lender partner gets the full basis boost.
Correct. It's a powerful way for that partner to increase their ability to take deductions or receive distributions, effectively leveraging their loan for personal tax benefits.
We briefly touched on that tricky situation where contributed property has an existing mortgage. Let's really dive into that specific nuance again.
Okay, the excess liability scenario.
Right. Say Tim contributes a building worth $500,000. His adjusted basis is $100,000, and there's a $225,000 mortgage on it, which the partnership fully assumes. Tim's a 1/3 partner.
Okay. This scenario perfectly illustrates that excess liability rule. It's a crucial exception to the general non-recognition rule.
So how does it work for Tim?
Here's the breakdown. The partnership takes on the entire $225,000 mortgage. Since Tim is a 1/3 partner, the other two partners collectively assume 2/3 of that $225,000 mortgage. That amounts to $150,000.
Okay, $150,000 is shifted to others.
Right. Now, here's the key trigger. Tim's original adjusted basis in the property was $100,000, but the amount of debt from the property that is effectively shifted to other partners is $150,000.
Which is more than his basis.
Exactly. Since this $150,000 in liabilities assumed by others exceeds Tim's $100,000 basis by $50,000, that $50,000 excess liability is treated as taxable boot to Tim.
So he has a $50,000 gain right away.
Yes. He recognizes a gain of $50,000 right at the time of contribution. And this recognized gain then, in turn, increases Tim's basis in his partnership interest, but only up to zero. His starting basis becomes zero.
Curious, I'm not negative 50,000.
Correct. And this brings us to a critical passkey that cannot be overstated. A partner's basis can never begin with a negative balance. Never. If liabilities assumed by the partnership exceed the adjusted basis of assets contributed, that excess is immediately taxable gain to the partner, and their basis starts at zero.
Why is that rule there?
It's designed to prevent a situation where a partner effectively reduces their basis below what they truly have at risk. It ensures the integrity of the tax system and prevents, well, artificial loss creation.
So once my initial basis is established, zero or otherwise, what about the holding period for this partnership interest? Does it start fresh when I contribute the property, or does it carry over from how long I've owned the asset?
This is an important detail, especially for future capital gains treatment.
Right. Long-term versus short-term gain.
Exactly. If the property you contributed was classified as a capital asset or a Section 1231 asset, think business property that gets capital gains treatment,
Okay.
then your holding period for the partnership interest includes the holding period of that contributed property and the tax on.
That's good. Helps qualify for long-term rates.
It's a significant advantage, yes. It helps ensure long-term capital gains treatment if you've held the underlying asset for a long time before contributing it. However,
Catch.
if the asset you contributed was an ordinary income asset, like inventory, your holding period for the partnership interest begins fresh on the contribution date.
Okay, so the type of asset matters for holding period too.
It does. This distinction can be critically important for future capital gains treatment when you eventually dispose of your partnership interest.
So your basis isn't a static number, right? You don't just calculate it once and forget it. It changes over time with the partnership's activities.
That's absolutely right. Your basis is a dynamic figure. It needs to be adjusted annually.
Okay.
Think of it like your personal bank account within the partnership.
Yeah.
It goes up and down.
What makes it go up?
It increases with additional cash contributions you make, your share of all partnership income, and gain items, whether it's ordinary business income or separately stated gains like capital gains. And crucially, increases in your share of partnership debt.
And what makes it go down?
Conversely, it decreases with distributions you received cash first, then property, your share partnership loss and deduction items, and decreases in your share of partnership debt.
So lots of moving parts.
Many moving parts. Maintaining accurate, meticulous basis records is paramount, not just for tax compliance, but especially for strategic planning.
Why strategic planning?
Because it directly impacts your ability to deduct losses and receive tax-free distributions. Ignoring these annual adjustments can lead to, well, missed deductions or unexpected taxable events down the line. You really need to stay on top of it.
Here's another scenario that sounds like it could have significant, maybe unexpected tax implications.
All right.
What happens if property contributed to a partnership has a built-in gain or loss? Meaning, its fair market value is different from its adjusted basis at the time of contribution. Who bears that gain or loss when the property is eventually sold by the partnership?
Yes. Section 704C. This is absolutely crucial for fairness among partners and for preventing inequitable tax burdens.
Fairness, okay.
Any built-in gain or loss that existed at the contribution date, that difference between FMV and basis at that moment, must be specially allocated back to the contributing partner when that property is later sold.
Only to the contributor, not shared.
Correct, for that pre-contribution portion. This prevents other partners from being taxed on appreciation that occurred before they were even involved, or from unfairly benefiting from losses that weren't really theirs economically.
It equalizes things.
Exactly. It's a way to equalize the playing field. Now, any post-contribution gains or losses, those that accrue after the property is brought into the partnership, those are then allocated among all partners according to their agreed-upon profit-sharing ratios.
Okay, so there's a split. Pre-contribution gain loss to the contributor, post-contribution shared.
Precisely. And this rule isn't just about compliance. It's a critical point for due diligence when you're acquiring a partnership interest. You need to understand if there are hidden tax liabilities or maybe benefits tied to specific assets that will only hit one partner, not the whole group, it affects the value of that interest.
Let's walk through a precise example to really solidify this. Joan contributes property. Basis $100,000, FMV $150,000.
Okay, so a $50,000 built-in gain.
Right. Later, the partnership, where Joan has a 20% interest, sells that property for $180,000.
Okay.
How much gain does Joan recognize in year 1 when she contributes, and then in year 3 when the partnership sells?
Okay, let's break it down. In year 1, Joan recognizes no gain from the contribution itself. That's the general rule we discussed.
Right, non-recognition.
However, that $50,000 gilt-in gain, the 150K FMV minus the $100K basis at contribution, is now earmarked specifically for her. It's a deferred gain waiting to be triggered.
Got it.
When the property is sold in year 3 for $180,000, the partnership realizes a total gain of $80,000. That's the 180K sales price minus the partnership's carryover basis of 100K.
Okay, $80,000 total gain.
Now, here's the critical allocation step. The initial $50,000 built-in gain, which existed at contribution, is allocated entirely to Joan.
All $50 to her.
Yes. The remaining $30,000, 80K total gain minus the 50K built-in gain, is the post-contribution gain. This is the appreciation that happened while the partnership owned the asset.
And that gets shared.
Correct. This $30,000 is split among all partners, according to their ownership percentages. Since Joan has a 20% interest, she gets an additional $6,000, 20% of $30,000.
So her total gain is?
Her total recognized gain in year 3 is $56,000. That's the $50,000 built-in gain plus her $6,000 share of the post-contribution gain.
$56,000, okay.
This mechanism ensures that the original disparity is corrected, and only the gains accruing during the partnership's ownership are shared by all. It maintains fairness.
So that was outside basis, your personal stake in the partnership. But the partnership itself, as an entity, also needs to track its investment in the assets it holds. That's where inside basis comes in. How does that work, especially for contributed property, and how does it relate to outside basis?
That's a crucial distinction to keep clear. The partnership's basis in contributed property, known as its inside basis, is generally the contributor's adjusted basis.
So it just carries over.
Exactly. It's a carryover basis.
Yeah.
This holds true even for the holding period. The partnership's holding period for that asset includes the time the contributing partner held the property before contribution.
Okay.
It's important to continually differentiate. Outside basis is the partner's personal basis in their ownership interest, like owning stock. Inside basis is the partnership's basis in its assets, like a corporation tracking its equipment basis.
And the carryover basis ensures continuity.
Right. Continuity of tax treatment. The tax characteristics of the asset largely remain the same within the partnership as they were with the contributing partner.
Let's trace the interplay between these two types of basis, inside and outside, with that detailed example of Jeff again.
Okay, Jeff and his K&C partnership.
Right. He contributes cash and a building with a liability in year 1, then another building in year 2, and the partnership earns income. Walk us through how this impacts his initial outside basis, how it changes over time, and simultaneously the partnership's inside basis in those assets.
Okay, let's break down Jeff's situation step by step. It really illustrates the dynamic nature. In year 1, Jeff's initial outside basis in his K&C partnership interest is calculated as $50,000.
How do we get $50,000 again?
He contributed $10,000 cash and a building with an adjusted basis of $100,000. That's $110,000 total. The building had a $90,000 mortgage. Since Jeff is a 1/3 partner, 2/3 of that $90K liability, or $60K, is effectively shifted to the other partners.
Right, the liability relief.
So his calculation is $10 cash plus $100 building basis, $60K, liabilities assumed by others. That results in his initial outside basis of $50,000.
Got it. And the partnership's inside basis in that building?
Simply Jeff's adjusted basis of $100,000, carryover basis. And its holding period carries over too.
Okay, that's year 1. Now, year 2.
Now, fast forward to the end of year 2. Jeff's outside basis increases dynamically. It starts with his $50,000 beginning basis from year 1.
Okay.
Then he adds the $300,000 adjusted basis of the second building he contributed in year 2.
At $300.
Right.
Yeah.
Finally, he adds his share of the partnership's ordinary business income from year 2. The partnership earned $150,000, and his share is 1/3. So that's $50,000.
Add $50K.
Exactly. So $50K start plus $300K building plus $50K income. That brings his outside basis to a robust $400,000 by the end of year 2.
$400,000 outside basis and the inside base.
The partnership's inside basis for that newly contributed second building also takes a carryover basis of $300,000 from Jeff.
Okay.
These examples vividly demonstrate the dynamic interplay between inside and outside basis and how absolutely critical it is for any business owner to meticulously track these figures. For accurate tax reporting, yes, but also for optimal financial planning.
To summarize basis for our listeners, the sources provide a great comprehensive formula. It shows how your tax basis in a partnership interest evolves from your beginning capital account.
So this is basically the roadmap, right?
It truly is your roadmap for understanding basis, a vital one for any partner to grasp. It starts with your beginning capital account,
Which is?
which is your initial economic investment, typically your cash contributions, the fair market value of services if you got a capital interest, or the net book value, basis minus liabilities, of assets you contributed.
Okay, starting point.
From that starting point, you make critical adjustments each year. You add your share of various income and gain items, like ordinary business income, separately stated income and gains, think capital gains, and even tax-exempt income. These all serve to increase your stake, building up your basis.
And the subtractions.
Conversely, you subtract your share of separately stated losses and deductions, non-deductible expenses like certain fines, and any distributions you receive.
Distributions reduce basis. Yes. Cash first, then the adjusted basis of property received. And finally, and this is that crucial element that often distinguishes partnerships.
The debt part.
Right. You add your share of all partnership liabilities, covering both recourse and non-recourse debt.
And that's why partnership basis can be higher than S-corp basis.
Often, yes. This inclusion of debt is what frequently makes partnership basis significantly higher, providing much greater capacity for loss deductions and tax-free distributions.
Yeah.
So the critical passkey here, the thing to really etch into your memory, is this distinction. Your total tax basis in your partnership interest equals your capital account plus your partner's share of partnership liabilities.
Capital account plus share of liabilities equals tax basis.
Exactly. And this is vital. Your tax basis can never go below zero.
Never negative.
Never. If distributions or losses would push it into negative territory, you either recognize a gain for cash distributions, which we'll discuss later, or you reduce your basis in any distributed property to prevent a negative outcome. It's a fundamental rule safeguarding the system.
Okay, let's shift gears a bit. For any partner, suffering a business loss is tough enough. But not being able to deduct it, that can be even worse. It means you might be paying tax on phantom income.
That's right.
Our sources clearly outline 4 distinct hurdles partners must clear to actually deduct a loss. This seems like where understanding the tax rules becomes a real strategic imperative.
Absolutely. These limitations are intentionally designed to prevent partners from deducting losses beyond their true economic investment and actual financial risk.
Keeping it grounded in reality.
Right. They ensure your tax benefits align with what you genuinely have on the line. The first 2 limitations, tax basis and at-risk basis, apply at the entity level.
Entity level first.
Meaning they first limit the amount of loss that can even flow through from the partnership to your personal tax return. Then the subsequent passive activity loss, PL rules, and the excess business loss limitations apply at the individual partner's level, further restricting what can be deducted against other income.
So it's a multi-step process.
It is. Understanding all 4 hurdles is absolutely vital for maximizing your loss deductibility and, consequently, your overall tax savings. It's a critical area for proactive tax planning.
So let's tackle the first hurdle, the tax basis limitation. How does this operate in practice, and what precisely happens if your share of the partnership's loss is greater than your personal basis?
Simply put, you can only deduct losses up to the amount of your tax basis in your partnership interest.
Up to your basis limit.
Exactly. As we discussed, this includes your investment, adjustments for income, distributions, and crucially, your share of partnership debt. If your allocated share of losses is greater than your current tax basis, the excess loss isn't lost forever.
It doesn't just disappear.
No. It's what we call suspended. It's carried forward indefinitely. Think of it like a rain check.
Okay.
You can use this suspended loss in future years, but only when your basis is sufficiently reinstated.
How do you reinstate basis?
Through future partnership income allocated to you, additional cash or property contributions you make, or increases in your share of partnership debt.
So you can eventually use the loss.
Right. This carry-forward mechanism allows you to eventually utilize the loss, but only when you have sufficient basis to absorb it. It ensures you're not deducting more than your actual investment.
Let's put this into an example. Becker contributes $30,000 basis to a partnership. Convisor contributes $6,000, much lower.
Okay.
Both partners withdraw $3,000. Then the partnership has an $8,000 ordinary business loss shared equally, $4,000 each. How much can each deduct?
Okay, let's walk through this. First, Becker.
Okay.
His initial basis was $30,000. After his $3,000 withdrawal, his basis before considering the loss is $27,000.
$27K basis.
His share of the loss is $4,000. Since this 4K loss is clearly less than his 27K basis, he can deduct his full $4,000 share. His ending basis will then be $23,000, 27K 4K.
Yeah, Becker's fine. What about Convisor?
Convisor's situation is quite different. His initial basis was only $6,000. After his $3,000 withdrawal, his basis before the loss is only $3,000.
Or 3K basis left.
Right. His share of the loss is also $4,000. Since his 4K share of the loss exceeds his 3K basis, he can only deduct $3,000 of that loss.
Limited to his basis.
Exactly. The remaining $1,000 4K loss, 3K deduction is a suspended loss. It's carried forward indefinitely.
But what if he never gets more basis?
That highlights a critical planning point and a potential pitfall. If his basis is not reinstated through future income or contributions, this suspended loss will effectively be lost forever if he disposes of his partnership interest before utilizing it.
Wow. So it can disappear.
He can. This is a real watch out for partners with low basis, emphasizing why careful basis tracking is so vital.
So even if you clear the tax basis hurdle, there's a second equally important limitation, the at-risk limitation.
That's right. Hurdle number 2.
How does at-risk basis differ from your regular tax basis, and why is this distinction so crucial, particularly for certain types of debt, like maybe real estate loans?
Your at-risk amount is generally quite similar to your tax basis, but with one absolutely critical difference. Certain non-recourse debt is excluded from your at-risk calculation.
Excluded? Which non-recourse debt?
Specifically, qualified non-recourse financing, often called QNF, is included in your at-risk basis.
What's QNF?
It's typically a standard bank mortgage on real estate obtained from an unrelated commercial lender. The IRS considers this specific type of non-recourse debt at risk because the property securing it is part of your investment, and the income from that property will likely repay the loan.
Okay, so QNF counts for at-risk.
Yes. However, other non-recourse debt may be debt secured by assets not considered QNF, or debt from related parties, is not included in your at-risk basis.
So even if it boosts your tax basis, it might not boost your at-risk basis.
Precisely. This means if your losses are largely supported by this other non-recourse debt, you may not be able to deduct them, even if you have sufficient overall tax basis. You get stopped by the at-risk rules.
That seems really important for real estate deals.
Incredibly important for real estate partnerships or those with specific non-recourse debt structures. It can absolutely be the difference between deducting a loss now or having it suspended and carried forward.
Let's delve into an illustrative example to really clarify this. ABC partnership, 3 equal partners. A and B are general partners. C is a limited partner.
Yeah.
The partnership borrows 3 types of debt. $60,000 in QNF debt, qualified non-recourse financing, $30,000 in other non-recourse debt, and $20,000 in recourse debt.
Okay, a mix of everything.
Right. How does each partner's specific tax basis and their at-risk basis get impacted by these different types of debt?
This example perfectly illustrates the difference in the crucial nuances. Let's take each debt type.
Okay. First, the recourse debt.
Recourse debt, $20,000. This $20K is split equally between general partners A and B, $10,000 each. Why? Because they have personal liability. This $10K increases both their tax basis and their at-risk basis.
What about C, the limited partner?
Limited partner C, having no personal liability, receives no allocation of this recourse debt for either basis.
Got it. Next, the QNF debt.
Qualified non-recourse financing, QNF debt, $60,000. This is allocated equally among all 3 partners, $20,000 each, because it's non-recourse and based on profit-sharing ratios, equal partners here. This $20K increases both their tax basis and their at-risk basis.
Because QNF is considered at-risk?
Correct.
Finally, the other non-recourse debt.
Other non-recourse debt, $30,000. This is also allocated equally among all 3 partners, $10,000 each, based on profit sharing. Now, here's the key. This $10K does increase their tax basis. But crucially, it does not increase their at-risk basis because it's not qualified non-recourse financing.
Okay. So let's tally it up. For A and B, general partners.
For partners A and B, their total tax basis increases by $40,000. That's $10 recourse plus $20K QNF plus $10 other non-recourse, but their at-risk basis only increases by $30,000. $10K recourse plus $20K QNF.
$40K tax basis, $30K at-risk basis. What about C, limited partner?
Your partner C, her tax basis increases by $30,000, $20K QNF plus $10 other non-recourse, but her at-risk basis only increases by $20,000 QNF only.
$30K tax basis, $20 at-risk basis. Wow.
This complex breakdown powerfully demonstrates how strategic debt financing can profoundly influence loss deductibility. A partner might have enough tax basis, but be limited by insufficient at-risk basis, leading to suspended losses.
A prime area for planning.
Absolutely. Knowing these specific rules allows for truly effective tax planning and optimization.
So, if a loss is suspended because it hits one of these limitations, tax bases, or at risk, what's the practical difference in how it's carried forward? Are the rules identical?
That's a great question. And there are subtle but important distinctions, especially for exit planning.
Okay.
If a loss is suspended due to the tax basis limitation, it carries forward indefinitely to offset future income when your tax basis is reinstated.
Mhm.
However, and here's the critical caveat, if you dispose of your partnership interest before generating sufficient basis to use it, that suspended loss is lost forever.
It just vanishes.
Poof. Poof. It simply disappears. An at-risk suspended loss also carries forward indefinitely and can be used to offset future income when your at-risk basis is reinstated, but it has an important additional benefit.
Which is?
It can also be used to offset any gain you realize from selling your partnership interest.
Ah, that's valuable. A safety net on exit.
It is. It's a valuable distinction for exit planning. Beyond these, passive activity losses carry forward to offset future passive income, and excess business losses, which is a newer limitation, carry forward as net operating losses, NOLs.
So each type of the suspended loss has its own rules.
Exactly. Knowing them is key to effective utilization and maximizing your tax benefits over time.
Let's tackle a comprehensive example that ties these first two loss limitations together, tax basis and at risk.
Okay, let's do it.
Rachel starts an LLC. She contributes $20,000 cash. She's allocated $5,000 recourse debt because she personally guaranteed it, and also $8,000 non-recourse debt that is not QNF.
Okay, 20K cash, 5K recourse, 8K are in non-QNF non-recourse.
Right. Her share of the LLC's loss for the year is $35,000. How much can she actually deduct, and how do these two limitations apply?
This is a perfect real-world example of how these limitations stack up. First, let's calculate Rachel's full tax basis.
Okay.
It's her $20K cash contribution plus the $5K recourse debt, because you guaranteed it, plus the $8K non-recourse debt. So her tax basis totals $33,000.
$33K tax basis. Got it.
Next, we calculate her at-risk amount. This is her $20K cash contribution plus the $5K recourse debt. The crucial point here.
The non-QNF debt.
Right. The $8K non-recourse debt is not included in her at-risk amount because it's not qualified non-recourse financing. So her at-risk amount is only $25,000. 20K cash plus 5K recourse.
25K at risk. Okay, basis limits are set. Now the loss.
Now, we apply the $35,000 loss. First, it hits the tax basis limit. Since her loss, 25K, exceeds her tax basis, 33K, $2,000, 35K, 33K is immediately suspended due to insufficient tax basis.
$2 suspended right off the bat.
Correct. This leaves $33,000 of the loss that cleared the first hurdle. This remaining 33K then hits the at-risk limit. Since her at-risk amount is only $25,000, $8,000, 33K, 25K is suspended due to insufficient at-risk basis.
Another 8K is suspended.
Right. Therefore, Rachel can only deduct $25,000 of the original $35,000 loss in the current year.
$25,000 deductible. What happens to the suspended parts?
The $2,000 suspended by tax basis is carried forward indefinitely until her tax basis is reinstated.
Right.
The $8,000 suspended by at-risk is carried forward indefinitely until her at-risk basis is reinstated.
Wow. This really shows how crucial it is to understand both limits.
Absolutely. They can significantly restrict your immediate deductions and really underscore the value of strategic debt structuring. Hashtag TAG-IV, key tax elections, and partnership transactions.
Okay, moving beyond the day-to-day basis tracking and loss limits, partnerships also have important tax elections to make. These can profoundly impact their overall tax liability, right?
They can significantly.
Who typically makes these decisions? Is it each partner individually or the partnership as a whole? And what are some key elections business owners should know about for, maximum tax efficiency?
Generally, most elections that affect the calculation of taxable income were actually made by the partnership itself, not by the individual partners.
The partnership decides. Why?
It centralizes the tax decision-making, makes things more efficient, more consistent across the board.
Okay. What kinds of elections are we talking about?
There are quite a few important ones. For example, the immediate expensing of organizational expenditures and startup costs.
Section 179 but for startup costs.
Sort of. It allows the partnership to quickly deduct those initial business expenses rather than amortizing them over many years. Big cash flow benefit early on.
Makes sense. What else?
Choosing accounting methods, cash or accrual. This significantly impacts when income and expenses are recognized. Inventory methods like FIFO or LIFO. Selecting a tax year, although there are restrictions there.
Usually calendar year.
Usually calendar year, unless it aligns with the majority partner's tax years or there's a business purpose.
Hmm.
Also, various depreciation methods, MECRS, straight line dictating how quickly assets are expensed.
Okay.
Electing out-of-installment sale treatment, if you want to recognize all the gain immediately for some strategic reason. And a really big one, making a Section 754 election.
Section 754, what's that?
That allows for optional basis adjustments to the partnership's inside basis. It can be incredibly beneficial upon the sale of a partnership interest or the death of a partner. It helps prevent double taxation of gain or can allow for additional depreciation for the acquiring partner.
So it adjusts the inside basis to match the outside event.
Essentially, yes. It aligns the inside basis with the outside basis changes. These elections offer powerful strategic opportunities to actively manage and often reduce the partnership's overall tax burden.
That makes perfect sense. Now, what happens if a partner engages in a transaction with the partnership, but they're not acting in their capacity as a partner?
Like selling property to the partnership.
Exactly. Or providing services like an independent contractor would, not as part of their partner duties. How does the tax code view these interactions?
Generally, these types of transactions are treated as if they occurred between the partnership and a completely unrelated third party.
So just like a normal arm's length deal?
Pretty much. The normal rules for sales, services, or loans apply, rather than the specific partnership distribution or contribution rules. However, there's always a however in tax.
Of course. What's the catch here?
There are very important limitations in anti-abuse rules, especially for related party transactions.
Related parties. Who counts as related here?
A related party in this context is typically a controlling partner. That's usually defined as someone holding over a 50% interest in either the capital or profits of the partnership.
Over 50%. Okay.
These rules are specifically designed to prevent partners from manipulating transactions with their own controlled entities for an unfair tax advantage.
So if a controlling partner sells property to the partnership at a loss, maybe to try and get a quick tax deduction, can they actually deduct that loss?
No. Losses are specifically disallowed between a controlling partner, over 50% owner, and their controlled partnership from the sale or exchange of property.
Disallowed completely.
Yes. This rule prevents artificial loss creation. You can't just sell an asset at a paper loss to your own partnership to get a tax break while effectively keeping control of the asset through the partnership.
Makes sense. It stops tax games.
Exactly. It ensures the economic substance of the transaction is respected.
And what about gains in these related party transactions? Do they get special treatment too?
Yes, they do. And again, it's another anti-abuse rule to watch out for. Gains between a controlling partner and their controlled partnership, or even between two commonly controlled partnerships, are treated as ordinary income if the property transferred is not a capital asset in the hands of the transferee, the buyer.
Ordinary income, not capital gain. Why?
This rule is designed to prevent converting what would normally be ordinary income into lower tax capital gains through related party sales.
Can you give an example?
Sure. Imagine a controlling partner sells inventory, which is ordinary income property to them, to the partnership, and it's going to be inventory for the partnership too. Any gain they realize from that sale is taxed as ordinary income, not capital gain.
So it keeps the income character consistent.
Right. It prevents tax arbitrage by just moving assets between related entities.
Okay, let's talk about something very common, especially in professional service firms. Guaranteed payments.
Oh, yes. Guaranteed payments.
Partners receive these for services or for the use of their capital, and it happens regardless of the partnership's overall profitability for the year. How are these treated for tax purposes, both for the partnership and the partner getting paid? It sounds like a salary, but I guess it has distinct tax rules.
Guaranteed payments are indeed treated somewhat like reasonable compensation, but they operate under special tax rules within the partnership context.
How so?
For the partnership, these payments are an allowable tax deduction, just like paying a salary to an employee. This happens whether the partnership has sufficient income or not.
So it reduces the partnership's taxable income.
Correct. It directly reduces the partnership's taxable ordinary income that flows through to all the partners. Now, for the recipient partner, guaranteed payments are taxable ordinary income, plain and simple. They're reported to the partner on their Schedule K-1.
Ordinary income. Got it.
Yeah.
What about self-employment tax?
Yes. For services provided, these payments are also included in net earnings from self-employment. So they are subject to self-employment taxes, Social Security, and Medicare.
Okay. Any other catches?
Yes, and this is a key point for many business owners today. Guaranteed payments are not included in qualified business income QBI, for purposes of the Section 199A QBI deduction.
Not QBI. That's huge. That's that potential 20% deduction.
Exactly. Guaranteed payments don't qualify for that potentially valuable pass-through deduction. This distinction is vital for a partner's overall tax planning. It means the structure of partner compensation can significantly impact their eligibility for the QBI deduction, a major area for tax optimization discussions.
Let's put this into practice. James is a 50% general partner in ABC partnership. He's paid $20,000 in guaranteed payments for his services during the year.
Okay.
The partnership's ordinary business income before accounting for this payment was $100,000. How does this all shake out on the tax returns? For both the partnership and for James.
Okay. For the ABC partnership, that $20,000 guaranteed payment to James is treated as a deductible expense.
So partnership income becomes...
It reduces the partnership's ordinary business income from $100,000 down to $80,000. This deduction effectively lowers the amount of ordinary income that then flows through to all partners, including James.
Okay, $80K flows through. What about James's personal return?
For James, his income from the partnership is twofold. First, he receives his 50% share of that remaining $80,000 ordinary business income. That's $40,000.
His share of the profits.
Right. Plus, he also has to include the full $20,000 guaranteed payment as ordinary income on his personal tax return.
So $40K plus $20K.
Exactly. James has a total of $60,000 in income from the partnership, $40K share of ordinary income plus $20K guaranteed payment. And that $60K is subject to both income tax and, because it includes the guaranteed payment for services, self-employment tax.
Got it. It really shows the dual nature deduction for the partnership, ordinary income for the partner.
Precisely. It impacts both sides of the transaction clearly.
So what about payments to a retired partner? If they're not for liquidating their capital interest, but more like an ongoing retirement benefit, how are those treated?
Those are generally treated as ordinary income to the recipient retired partner, similar to receiving a pension or annuity payment.
And for the partnership?
They are fully deductible by the partnership. It provides a clear tax treatment for those ongoing retirement obligations, separating them from the potentially more complex rules around liquidating a partner's actual capital interest.
Okay, let's talk about one of the most common actions partners take. Getting money or property out of the partnership.
Taking distributions.
Right. When you take a non-liquidating distribution, meaning you're not closing down the partnership or fully withdrawing your entire interest.
Just taking some assets out.
Exactly. Is that generally a taxable event for either the partner or the partnership? This seems like a question a lot of business owners must have.
And it's a good one. Generally, non-liquidating distributions of cash or property are non-taxable for both the partner and the partnership.
Non-taxable. That sounds great.
It is. This is another truly significant tax advantage of partnerships. It allows partners to withdraw funds or assets with remarkable tax efficiency as long as they have sufficient basis.
So basis is key here too.
Always. These distributions simply reduce the partner's outside basis in their partnership interest by the amount of cash received or by the adjusted basis of the property distributed.
Does it matter if it's cash or property?
Yes. Cash distributions always reduce basis first. That's an important ordering rule. This allows for incredibly flexible withdrawals without triggering an immediate tax event, unless, as we'll see, certain specific thresholds are met. It's an excellent tool for managing personal cash flow from the business tax efficiently.
So if the partnership distributes property to me, not cash, what's my basis in that property once I receive it? And how does that affect my remaining partnership interest basis?
Okay, for property distributions, your basis in the distributed property is typically the same as the partnership's inside basis in it immediately before the distribution. A carryover basis, essentially.
My basis equals the partnership's basis.
Typically, yes. And your partnership interest outside basis is then reduced by that same amount. However, there's a crucial limitation. A cap, if you will.
What's the cap?
If your partnership interest basis, after accounting for any cash distribution you might have also received in the same transaction, is less than the property's adjusted basis, then your basis in the distributed property gets reduced.
Reduced to what?
It's reduced to match your remaining partnership interest basis. And your partnership interest basis then goes to zero.
Ah, so you can't take more basis in the property than you had left in your partnership interest.
Exactly. You can't take a basis in the property that would cause your partnership interest basis to go negative. This rule ensures that your total basis in the property you received, plus your remaining partnership interest, which is now zero, doesn't exceed the basis you had in the partnership right before the distribution. It maintains the integrity of the basis rules.
Is there ever a time when a non-liquidating distribution does trigger a gain for the partner? You said generally non-taxable, which implies exceptions.
Yes, and this is a critical watch out for partners. It often catches individuals by surprise.
What is it?
If you receive a cash distribution that is greater than your basis in your partnership interest, you must recognize a capital gain for that excess amount.
Only for cash, not property.
Correct. Only for cash distributions in excess of basis. Unlike property, where your basis in the received asset can be adjusted downwards to avoid a negative partnership basis.
Right. Property basis can be reduced.
Cash basis cannot be reduced. You received cash, its basis is its face value. So a gain is immediately recognized to prevent your partnership basis from falling below zero, which, as we keep saying, is not permitted under tax law.
So tracking basis is vital to avoid surprise taxes on cash withdrawals.
Absolutely vital. An unexpected cash distribution, maybe a year-end bonus or something, could suddenly become a taxable event if your basis wasn't high enough. Turns a simple withdrawal into a capital gain.
What if the partnership distributes a mix of assets, say some cash, some inventory, and a piece of land? And my outside basis isn't enough to cover the total adjusted basis of everything I'm receiving.
The multiple asset distribution scenario with insufficient basis.
Right. How does the tax code prioritize which assets get the remaining basis I do have?
If your partnership interest basis is less than the total adjusted basis of multiple assets distributed, your remaining basis must be allocated among them. Again, this prevents your partnership interest basis from going below zero.
Is there an order?
Yes, the rule is very specific and follows a strict prioritization scheme. Basis is assigned first to cash received.
Cash first. Makes sense.
Then, basis is allocated to what the tax code calls hot assets.
Hot assets. What are those?
Things like inventory and unrealized receivables. Basically, assets that generate ordinary income upon sale, not capital gain.
Why prioritize them?
We prioritize allocating basis to these because the IRS wants to make sure that ordinary income character is preserved for tax purposes when you eventually sell them. You can't easily convert ordinary income into capital gain by taking property with a low basis.
Okay, so cash, then hot assets. Then what?
Then, any remaining basis is allocated to other property, like capital assets or Section 1231 assets like that land.
This hierarchy ensures ordinary income assets get basis first.
Exactly. It ensures assets with ordinary income potential are accounted for before other capital assets get basis allocated to them.
Let's run through that last complex scenario with Olinto. He has a $30,000 outside basis in his partnership interest.
Okay, $30 basis.
He receives a non-liquidating distribution consisting of $24,000 cash, inventory, a hot asset with a partnership basis of $5,000, and a piece of land with a partnership basis of $9,000.
Okay, cash, inventory, land. Total partnership basis distributed is $24K plus $5K plus $9K plus $9K equals $38,000. But Olinto only has $30K outside basis.
Right. So how does his $30,000 basis get allocated among these assets, and what's his basis in each asset received?
This is a perfect final example to tie these distribution rules together. Let's break this down step by step following the hierarchy. Olinto starts with a $30,000 outside basis.
Step 1, cash.
First, we apply the cash distribution. The $24,000 cash reduces his basis from $30,000 down to $6,000, $30K, $24K. His basis in the cash received is simply $24,000.
Okay, $6K basis left. Step 2, hot assets.
Next, we move to the hot assets, the inventory. The inventory has a partnership basis of $5,000. This amount is fully allocated to the inventory since he has $6K basis remaining. This further reduces his remaining partnership interest basis from $6,000 down to $1,000, $6K balake.
So his basis in the inventory is $5,000, and he has $1K basis left in his partnership interest.
Correct. Step 3, other property.
The land. Partnership basis was $9,000.
Right. Finally, we allocate the remaining basis to the other property, the land. The land has a partnership basis of $9,000, but Olinto only has $1,000 of remaining basis in his partnership interest.
So the land only gets $1,000 basis.
Exactly. His basis in the land is reduced to $1,000, matching his remaining partnership interest basis, and his partnership interest basis then becomes zero.
Zero outside basis left.
Correct. So, to summarize Olinto's situation after the distribution, his basis in the cash received is $24,000, his basis in the inventory is $5,000, and his basis in the land is only $1,000.
Wow. Even though the partnership's basis in the land was $9,000.
Right. This detailed example shows precisely how to navigate a potentially complex distribution to understand the exact tax implications. And it ensures, once again, that a partner's basis never falls below zero, a fundamental rule in partnership taxation.
Mm.
Hashtag outro.
Wow. That was an incredibly comprehensive deep dive into partnership taxation. Seriously.
We covered a lot of ground.
We really did. From laying the foundation with that flow-through advantage at formation to the intricate calculations of basis, both inside and outside, the critical hurdles of loss limitations, tax basis, at-risk, PAL, excess business loss, and then the nuanced rules around distributions.
Yeah.
It's abundantly clear that understanding these rules isn't just about, like, passive compliance.
Not at all.
It's about active, smart financial planning and ultimately keeping more of what you've earned in your pocket.
Absolutely. Every single decision you make within a partnership, from how you contribute property or services to how you choose to take distributions, how you structure debt, it all has a direct and significant tax consequence.
No doubt.
Knowing the fundamental difference between a capital interest and a profits interest, or how various types of debt affect your at-risk basis, that can profoundly impact your immediate tax liability and, crucially, your ability to deduct losses.
Which hits the bottom line hard.
It does. Critical thinking about these details is absolutely essential in, a world drowning in information. It's the key to truly optimizing your tax position within a partnership structure.
So what does this all mean for you, the savvy business owner or entrepreneur listening right now? The next time you're considering forming a partnership, or maybe you're already operating as one, remember that the tax code isn't just a set of rigid, annoying rules. It actually offers powerful tools for optimization.
It really does.
The key is to be informed, to understand the levers you can actually pull. Our sources today have given us, I think, a robust framework for understanding how to not only avoid common pitfalls, but also how to strategically leverage the system for maximum tax benefit.
And if we connect this to the bigger picture, it raises an important question for you, the listener, to ponder.
Okay.
How might a deeper understanding of these specific and impactful tax rules encourage you to perhaps reevaluate your current business structure? Or maybe even influence your future investment strategies? How can you better align everything with your long-term financial goals and ensure you're always making the most tax-efficient choices possible?
That's a truly provocative thought to leave you with. And it beautifully encapsulates our philosophy here. Knowledge is most valuable when it's understood and then actually applied.
Well said.
Keep digging, keep learning, and we'll be here next time to help you dive deep into your next stack of sources.